Well, hi guys, and welcome to the lesson on what is financial trading. Okay, so at the beginning of your trading journey, you're probably going to hear some words that you don't understand at first. Even if you're more advanced, you may still hear words that you don't fully understand. But there's going to be plenty of words that you do understand, such as interest rates, broker, commodity maybe, or dividend. But there's going to be some other words that you don't understand at the beginning, which is perfectly understandable, such as long and short, or EBITDA, like earnings before interest, tax, depreciation, and amortization. It's a way of valuing a business basically on its performance. So long basically means going long, you're going to be buying, okay, and if you're going short, you're going to be betting on the price coming down, so you're selling, okay. But all these sort of words will come clear later on. But beneath all of this terminology and beneath all of these different words and ideas, there's only one thing really that underpins financial trading, and that is forecasting, guessing and predicting whether something is going to go up in price or whether it's going to go down in price. So the simplest way of looking at it, if something's cheap and it's a low cost, then you buy it because you can sell it at a higher price. And that is basically really what financial trading is all about. But you can actually go the other way. But we'll get into that later on, because that's called shorting, when you are betting on the price coming down. So what we're going to do here, we're going to teach you ways and strategies in order to make more calculated decisions. So you never know which way the market's going to go, but you can use the fundamentals or the technicals to work out which way you think it might go. Because if everyone's thinking the same thing, then generally it might be going the same direction. So you can use fundamentals, things like interest rate decisions, interest rates or inflation rate, that sort of thing to drive your decision. Or you can use technical analysis when you're actually analysing where the price is using chart analysing and various different indicators to tell you which there's a possibility that it might be going that direction now. So, or using a combination of both. I mean, I tend to use a combination of both. For example, when we've got an interest rate decision coming up, I could look at the technicals before, but just generally overall, like I mentioned a second ago, it's all about buying at a lower cost and selling at a higher price. So there's lots of things to take into consideration when you are trading. You've got to think about what to trade. There's so many different instruments out there to trade. You've got to think about where to trade, how to trade, what opportunities there are out there, what techniques you can use to trade, and what your risk management strategy is. Because that's really what trading really boils down to. It's your risk management. How much you're prepared to risk, how much you're prepared to lose in that particular trade, because that is the most important thing. And what tends to happen with traders, they will risk maybe 1% on a trade. They might win that trade, and then they gradually win another trade, and then they start losing trades, but then they start increasing their risk. So instead of risking 1%, they're now risking 5% on every trade, so they're losing 5% every time, and it's keeping it consistent. And trading really is all about consistency, doing the same thing over and over and over again, and using the probability and the technicals and the fundamentals to make those decisions. So what is financial trading? In simple terms, it's the buying and selling of financial instruments. So there's lots of different instruments out there. We've got shares on this particular slide. So shares are companies such as Apple, Amazon, Google, Lloyds Bank. And then you've got indices. Now indices are a group of companies such as the Dow Jones, the FTSE 100. So you can imagine the FTSE 100 is the UK top 100 companies. And then you've got the S&P 500 or the NASDAQ, which is tech companies. Then you have foreign exchange, so forex as it's known as. So global currency. So basically here you're buying maybe the pound and you're selling the dollar at the same time. So you're basically swapping one currency for another currency. So, and then you have commodities. So commodities can be physical assets such as raw materials, agricultural products, for example, gold, oil, wheat, soy or gas. Companies may use some of these commodities as they need them to trade with, or not trade with, but buy and sell with, or they might use oil, for example, to fuel their vehicles, or a company may use natural gas or something for their company. There's lots of different usage of various commodities, or you can trade them on various different exchanges, which I do myself. I'm actually buying gold at times, but it's not buying real gold. I'm buying CFDs, they call it, the contracts of gold, basically. So you're following the price of the gold. So that is really commodities. Now, foreign exchange, you might have used foreign exchange in the past. You may have moved, flown from one country to the next, or just traveled from one country to the next. So you're going to be swapping your own currency for another currency. So if you're in the UK and you're traveling to the US of A, you may swap your pounds for dollars. And if you're doing that, then you're participating in the foreign exchange or the forex market. But like what I just mentioned about the companies actually buying and selling the products, or buying the products for them to use, but most of the time, companies don't necessarily need to buy the actual asset themselves. They'll just be buying them and then selling them using the price fluctuations to make a profit, basically, similar to what I do with the gold and the silver and the commodities that I trade myself. So with commodities, there's lots of different areas where you can trade commodities, and foreign exchange or any of these particular instruments. But just like any other form of market, the financial markets are where buyers and sellers come to trade. They basically buy and sell, or they sell and they buy. So there's often physical locations that traders meet to exchange certain types of assets. So you've got the shares at the London Stock Exchange, the LSE, you've got the New York Stock Exchange, you've got the commodities at the Chicago Exchange. So there can also be electronic systems like the NASDAQ Stock Exchange or the Foreign Exchange. So a cryptocurrency exchange, for example, is a digital marketplace which allows peer-to-peer exchange of crypto assets. And there's decentralized exchanges like Binance, Coinbase, Kraken. They're some of the largest. So financial markets enable traders to exchange assets fast and easily. Sometimes all of the buyers and the sellers are in one place. They're buying and selling. But other times the buying and selling takes place electronically. So they tend to have very strict rules and regulations, which helps to reduce illegal activity and fraud. For example, if you wanted to purchase some silk on a regulated commodity exchange, you could purchase it without checking it out physically, because you know it's been regulated, you know it's been checked, and you know that company that's selling that silk is actually verified by that particular exchange beforehand. So a couple of fun facts here. The stock market is more than 400 years old. There are more than 60 stock exchanges in the world. The stock market is 70% likely to go up in any one year. October is the most volatile month. September is the worst month, and the United States makes 40% up of the world stock market. Now, this is a thing with stock markets. I mean, all these figures can change, and they are, with the introduction of cryptocurrency and blockchain exchanges as well now, things are changing slightly, more regulations coming in, that sort of thing. But this is really an overview of the financial markets, and the financial markets are all available to trade online on various different platforms. Well, hi, and welcome to the lesson on what to trade and why to trade it. So why do we trade? So imagine having some savings. So you put your savings under your floorboards. I'm not saying you do this, but imagine you had done it in the past. So you've got a wad of cash, you put it under your floorboards, you leave it there for a few years, and then you go back to it. Now that cash wouldn't have grown at all. That cash would probably be worth a bit less today, actually, because the cost of living's increased. So you're going to get less purchasing power with the money you had. Now, let's imagine you had invested in some secure investment, something like gold, for example, or silver, some sort of precious metal, property, anything like that. The value of the gold or the property or the silver may have gone up in that same period of time. It may have gone down also. But generally speaking, over a long period of time, it could have gone up and increased. So when you're trading and investing in the financial markets, all about spreading your risk with the potential reward. Try to make calculated decisions, sensible decisions throughout your investment journey. Now this could reward you higher rather than just sitting on your cash and leaving it in a bank or under your floorboards. Now there's really a bit of a difference between investing and trading. Now investing is generally based on a longer period of time, whereas trading can be a lot quicker. I mean, sometimes day traders can be in and out of trades during the day, that's why they're called day traders, or it can even be in a few minutes, or even less in some cases. I mean, some active traders can trace potentially 100 trades or hundreds of trades in a day. But it's almost impossible for a day trader or any type of trader to manually trade throughout the night, 24 hours a day, 7 days a week, because obviously they've got to sleep. It's just impossible. And when you get tired, you're making the wrong decisions and that sort of thing. So one of our strategies here at Samrock is to make the most of our algorithmic trading bots. These bots can trade for you 24/7, but they need management as well. It's not a switch on, leave the bot on and let it run. I don't think there's a bot in the world. I've never found a bot that can actually do that and be successful forever. They might be successful for a period of time, but then they get into trouble. So it's vital really that you manage that trading bot if that's the route that you want to go to. So really, in essence, there's three different ways to get involved in trading the markets. There's investment, so long term, buying property, buying gold, something like that, buying the real asset. And then you've got your trading, where you might use fundamental analysis or technical analysis to decide on whether you're buying or selling a certain instrument, or you use a computer to do it for you. But using a computer to do it for you, you still need to have the management of that particular algorithm to make sure that you don't get into trouble, because the bot will continue to buy and sell, buy and sell, buy and sell all the time. So it's vital that you manage it correctly. So all of the above, they've got their advantages and they've got their disadvantages, and it's vital that you find out what's best for you. It could be a bit of both or all three. So that's down to you to decide. So what I'd like you to do now is just write down on a bit of paper some ideas of what investments are, what trading actually is, and what algorithmic bot trading actually is, and get a bit of an idea of what suits you. You may be a long-term investor, so you prefer to buy something and just check in on it every so often, buy a stock at a low price because you believe in that particular company. Or you may prefer to be a trader, so you can actually be in and out of trades on a daily basis. You may be a mid to long-term trader, so you could be buying, almost investing. I mean, most of my success through trading has come through buying commodities on CFDs over a long period of time. So I'm basically buying low and then I'm selling high. And sometimes I can be in a trade for a number of months. The only problem is with that I mean, it's okay to get in and out. You need a fair size account to be able to trade that way. But my success rate is probably about 98% wins, because I'm just buying low and I'm waiting and I'm waiting and I'm selling high when the price eventually goes up. So if you're buying commodity, for example, it's like gold, for example, it's unlikely that gold is going to ever be worth nothing. So this is why I like trading gold over a mid to long term period. So there's lots of different ways. So have a think about what suits you and what area of investing and trading you would like to be involved in later on. Well, thank you for joining this lesson on trading, and I'll see you in the next video. Well, hi guys, and welcome to this lesson on stocks and shares. So in this video, I'm going to talk you through what stocks and shares are and how you calculate them and that sort of thing. So firstly, what actually is a share? So a share is like a unit of ownership for a company. So if a company is worth £25,000 and has issued 1,000 shares, that is basically 1,000 divided by 25,000. So it's £25 per share. So a company's share price can go up and it can go down depending on the situation with the company, which we'll get into later on. So if a company is worth £1 million, and let's say the company's issued 2,000 shares, just have a quick think about what the share value should be for that particular company. Okay, so what is a calculation? Have a think about that. You might need a calculator. Okay, so that's 500. Okay, so it's 2,000 into 1 million is £500 per share. So why do companies offer shares? Basically, it's to raise money. So what they're doing here is they're raising money to let the management invest in the company, which will help raise funds for the future development of the company. So if the company is expanding or launching something new, then the funds can be invested wisely. So the company then becomes more profitable, the value of the business could rise, and so will the share price. So the company and the shareholders sort of rely on each other. So the company needs the shareholders to raise the funds, and the shareholders hope that the company will use their funds and their investment to grow the business, therefore increasing the price of the share so that they can make a profit from their particular shares in the future by selling them. So why do share prices move? Shares can be volatile, they can fluctuate, they can go up, they can go down, they can even stagnate and not even move at all. They can remain stable for months, but there are reasons why the share price increases and decreases. It's based on one simple main reason, and that is supply and demand. As with anything really in this world, the more supply you have, the more demand you have. The more demand you have, the more price can potentially increase. So less supply, more demand, price goes up. This basic principle can be applied to any market, but generally speaking, if more people buy a share than the people that want to sell, the price will rise. And if more people sell than buy, the price will fall. So there's many things that can influence the supply and the demand. One of the things is the earnings. So the profits the business can make can really influence the share price. So if a company makes more than expected, then it can drive the price of the share higher. However, if the earnings are lower than expected, then this can cause the share price to fall. Earnings are normally shared quarterly, half or full yearly. So what we're doing here is forecasting for that particular company in that particular quarter. For example, that company is going to make X amount. It's on the forecast. It's on the data. The data's there, ready to read. This is what everyone's expecting. So if everyone's expecting the earnings to be here, but it comes out and the earnings are actually here, that's going to encourage people to buy the shares and push the price of the share up. Whereas if the earnings are expected to be here and the price actually comes out here, then people may sell their shares and push the price down. So what can influence the supply and demand? So speculation and sentiment. So this is probably the most important factor to influence share price. Expectations of the company can affect the share price considerably, such as expectations of a company's future performance. So when you've got things like legislation that could affect the industry, it could affect the industry positively or it could affect the industry negatively. So if it's going to affect the industry negatively, then potentially it could push the price down. So faith in the company. So if you believe in that particular company, you believe in what they do. You believe in the team behind that particular company. What are that company doing different to everyone else? Is that the reason to buy those particular shares? So then the economy is also a big factor in affecting the share price. So how are shares traded? They can be traded on the stock market. So in the UK, mostly on the London Stock Exchange, and the US, you've got the New York Stock Exchange or the NASDAQ. Now, how are shares traded? On the stock market. So these exchanges are highly regulated. So buyers and sellers all come together to negotiate. This is only allowed for the qualified individuals to trade physically on the exchange itself. So most investors will need a stockbroker to act as a middleman, like myself, like you, like most retail or professional traders globally, they will need a broker. So what is a stockbroker? What is a broker? So a stockbroker is allowed to buy and sell stocks on behalf of their clients. So years ago, an investor would have to call up their broker on the phone. You've probably seen it in the movies to make that call to decide on what they were going to buy and how much whatever they were going to buy. And they would phone them up, and they have a landline, one of those big old classic phones, and that is how they would order their particular stocks. Now, these days, it all happens online. We can do it from our phones. We can do it from. I'm not recommending you trade from your phone because that's not a very good recommendation. But you can manage trades on your phone. You can buy on your computer. You can buy in various different ways. So there are 3 types of broker. You've got advisory, you've got execution only, and you've got full service. Now the advisory, they'll give you advice, recommend certain trades. However, the final decision is to be made by the client. With the execution only, this is just when the broker simply just places the trades. No advice is given here. So you might get an online system and a platform you sign up for, and you've got no advice there. You've literally got to do all of your homework yourself as a trader, as an investor. And then you've got the full service package, which some brokers offer, where they would design a strategy for you, work out what's best for you. Some people might want a small percentage a year, but they want it to be as safe as possible. Whereas some people might want a high percentage every month, and they're prepared to potentially lose more because they're more risky. So there's lots of different services there that can be offered by your particular broker. So have a quick think about which service provider, which service would charge the highest and the lowest commission out of these 3. So you've got advisory, execution only, and full service. Okay, so have a quick think about that. So it's quite self-explanatory. Obviously, the full service gives you the full package, so that's going to be the most expensive. And then execution is going to be the cheapest or the lowest cost. And they potentially would take a small portion of each trade that you potentially do. So when deciding on a broker, very important to understand your knowledge level in the markets and ensure that you're choosing the right service. And this is what we're here to do, is to ensure that you go in the right with the right mindset to your trading and your investing. Very important. So another thing which is very, very important that people don't really think about too much is times for trading. So stock exchanges only open during certain hours. We have different time zones. We've got market opens at different times throughout the day because of the different time zones. You've got to make sure that you take into consideration about clock changes. So in the UK, we have British Summertime, BST, which is 1 hour ahead of GMT, whereas when British Summertime actually takes place, the US hasn't actually gone forward an hour. So suddenly, normally the US Open, the New York Open, when the bell goes in Wall Street at 2:30 UK time. But British Summertime, there's a period of time when the bell goes actually at 1:30 UK time. It's only for a few weeks, but you've got to be aware of these sort of things because you don't want to be putting a trade on when the market's closed, or well, you won't be able to. But if you do all of your analysis, you're waiting for a trade for 3 or 4 weeks, and then suddenly you go in to buy then, and it's closed, then you would need to get in a bit earlier to make sure that you get in at the right time. So trading and investing is all about timing, and we obviously use the times, the various different strategies, fundamental, technical analysis to ensure that we minimizing our risk on what we are buying and what we're selling. So how are these shares listed on an exchange? So companies can either be privately owned or publicly owned. A private company won't be listed on an exchange. So this could be something like, let's just say, a hotel. A hotel, you invest in some shares in a hotel. So you buy those shares potentially through the owner, via legal processes, but you're actually buying via the owner. If the owners of that company wanted to go public, then yes, they could. They might want to do this to raise money and raise capital for the company, and then they would carry out an IPO. So, quick, have a think about what an IPO could potentially stand for. So, you may already know. So, IPO. Have a think about that. Okay. So, an IPO means initial public offering. Okay, so after the IPO, the company's shares are then listed on an exchange and normal investors can then buy and sell them. So that example, if you did float a hotel on the stock market, then you create an IPO, and then those particular shares in that particular hotel would be available for anyone to buy and sell via the exchange. So how are shares listed on an exchange? Public listed companies can have so many more shareholders than private ones. They are regulated, so there are many, many more restrictions. The rules will differ between each exchange, but generally the public business will need to appoint a board of directors so that they can disclose the detailed financial information. So the board of directors are going to be making sure that the regulation is covered all the time, and that allows them to be on the exchange. So when a profit is made, then the management will decide on how much to award as dividends and how much to invest back into the business. So for example, the FTSE 100, it's the top 100 companies in the UK. If you invest in the FTSE and you own shares in the FTSE and you hold them each month, then potentially if you hold them over the period of time of dividends, you may get issued some dividends payments. So it's another way of earning an income rather than just buying and selling the shares in that particular stock or index or whatever. So what I'd like you to do now I'd like to find an attractive stock, something that you resonate with, something you can get excited about. You know, maybe it's a tech company that's up and coming, and you look at the price of the shares and they're really low at the moment, but in a year's time, that tech is going to be used by everyone in the world. That's a good stock. That's a good share to invest in potentially. So have a look, find some shares, find some stocks, find some companies, do some bit of homework, and then what we'll do in the group sessions, we will discuss your stocks and your shares that you found and the reasons why, and we can analyze them all together and decide whether it's actually a good stock or share to buy, or whether we just steer clear of that particular stock or share. Thank you guys for joining. I'll see you in the next training. Well, hi guys, so in this training we're going to be looking at what are commodities. So commodities are not the same as shares, they're not the same as indices or forex or foreign exchange. They are physical assets. They can be farmed, they can be mined, extracted from the earth. So some of the examples on this visual here, you've got some wheat, you've got some gold, oil, and some cattle. So can you think of a commodity that you might use every day? Okay, so in this example we've got coffee. So you can actually trade coffee if you want to. So to be classed as a commodity and officially tradable, the commodity must be entirely interchangeable with another commodity of the same type. So to get your head around this, for example, silver is silver. So if it's extracted from Mexico, it'd have the same value as if it was extracted from China or Peru or United States or wherever it is extracted from. So 1 ounce is 1 ounce, 1 gram is 1 gram of silver, pure silver. Now this is the same for other commodities such as natural gas, copper, cotton, but they must meet the minimum purity and quality of the standards to qualify to be able to be sold. So this is called fungible, and it means that large quantities can be traded very quickly on an exchange. So you know that what you're buying is actually the real stuff and it's got a certain standard because it's all regulated. So all traders will know that they can buy with confidence as the quality criteria has already been met. So all they really have to think about is the price. So you've got different types of commodities here. You've got like soft commodities and hard commodities. So there's like 2 different groups of commodities. So soft commodities, these are normally farmed rather than mined or extracted from the earth. They can be agricultural, so they are susceptible for growing seasons and cycles. So really the weather can play a massive part in the price of what is produced. So if a crop, for example, was flooded because there's too much rain, then that can affect the price because another crop might not be flooded. And that other crop that's not flooded is when supply and demand comes in. So the other crop potential could be sold for more because there's less of the crop to sell. So hard commodities are generally mined, such as oil. They're like natural resources. They're easier to transport than soft. And you've got the spot market. So this is where financial assets are sold for cash and literally exchange right there and then. So if you need immediate delivery of a commodity, then you go to the spot market. So if you suddenly needed some oil, then you go to the spot market. So let's say a clothing manufacturer that uses cotton, they make a big clothes, they receive a big clothes order. They only have a limited amount of stock in-house, so in their warehouse they haven't got quite enough, but they've got to deliver this order. So they might go to the spot market to get more cotton delivered to their warehouse quickly so they can fulfill the order. And if you own a cotton farm, then you'd want to sell it on the spot market. Okay, and if there's less supply, there's not enough product, then potentially you can charge more money. So the spot market sets high standards for the commodities traded. This really means that traders can buy and sell without the need for a visual inspection. Now the futures market. Now this is where the marketplace where buyers and sellers agree to exchange a certain amount of an asset at a fixed date in the future. So it's a future price that you have to predict. So you buy at the price that has been agreed today. So the asset that is not traded physically on the exchange, the buyers and sellers participate in the futures contract instead. So it's a contract basically, it's a futures contract. This allows the traders to speculate on the price of the commodity and doesn't have to own them. Here the contracts can be closed or sold before the actual delivery date. So when I go buy gold, for example, I will be buying on a contract on the futures market because I'm buying that. And basically sometimes when a contract rolls over from a month to the next month, there'll be a gap in the price, and there's advantages and ways of trading that gap in the price, you see. So this is where the contract trading can be quite lucrative at times, but it can also be quite risky as well. So lots of things to take into consideration there. So we've got some goats here. So what this can be very useful if, for example, you want to trade on the price of goats, but you really don't want a load of goats turning up at your house just in time for Christmas. But you can still trade the price of the goats. So futures can be often used by individuals and companies looking to exchange the physical commodities at a later date. So they might not even take delivery of these commodities. So however, they're mostly used for speculation and hedging. And hedging is when you're buying and selling at the same time, but we'll get into that later on. The speculation is because you're speculating on a particular price, what it might happen in the future, and this is why the contracts are called future contracts. Okay, so the price of futures is normally different to buying and selling the same amount on the spot or the commodity market. The seller needs to take into consideration the risks and the fees, things like transportation and storage. So on my futures contracts that I trade, there is a swap fee. There's a big cost for the longer I hold that particular contract. So you've got to be careful that that doesn't wipe out all of your profit. So another thing to think about. So who trades commodity futures? There are four main types of commodity trader. You've got the producers. These can be individuals and companies that extract or produce commodities. They can enter into a futures contract, which can offset the risk of the future price changes. For example, if a wheat farmer agrees to sell a specific price on a specific date, then they will be guaranteed the income on that particular date. Now, even if the price drops significantly, they're still guaranteed that price because it's already been bought within that particular contract. Now you've got speculators as well. Now these are traders just looking for price movements basically. They are looking to see where they can profit. This is what I do. I speculate on the price. So I might buy gold or silver, for example, because the price is low and because I believe in the gold price going up in the future. So I'm speculating that the price is going to go up in the future. So maybe they'll start reducing interest rates at the moment in the US. When they do start reducing interest rates, that possibly will send gold a lot higher. So I'm speculating on the future. Okay, so you've also got the hedgers. These are mid to long-term investors. They will hold commodities in their portfolio. This provides protection against downward movements in price on some other securities. So commodities tend to be to move in the opposite direction to some stocks and bonds. So if there's a stock market crash, investors holding commodities may not be as affected as much. So for example, when the dollar goes up, the gold goes down. The price of gold will go down if we're trading gold against the dollar. So when some markets are unstable, then gold is seen as a hedge, as it's based as a safe haven. So the reason people buy the dollar is because when interest rates go up, they're going to get more dollar for their money. They're going to price of the dollar, you're going to get paid interest for holding that dollar. Whereas you don't get any interest from holding gold. So when the interest rates come down and get reduced, people tend to buy gold because it's a hedge and it's a safe haven. And when markets are unstable, it's a lot more stable because we know that gold is gold at the end of the day. So you have brokers, these can be firms or individuals who buy and sell commodities on behalf of their clients. And just moving over to the recap here. So commodities are physical assets that are mined, farmed or extracted from the earth. They can be soft commodities like agricultural or hard commodities like energies and metals. They are traded on either the spot market or the futures market. Okay, so futures is obviously the future. The spot market is generally used for buyers and sellers of the physical commodity, like a company or something, while the futures market tends to be dominated by speculators and hedgers, like traders like me, basically. So, and that is my overview of commodities. So commodities is my favourite subject to trade, actually, because I feel like they are tangible assets. For example, you could trade, something like soybeans, or like the coffee that we mentioned earlier in this particular video. So you imagine there's different cycles. You can look at the different cycles of when coffee price goes up. So it may go up in the summer months where it's grown, for example, and it may come down in other months. And if you look back at history and the same sort of cycles happening every year with that particular commodity, coffee we're talking about, then you can speculate and you could decide when to potentially buy and then potentially when to sell, because it's done it before in that motion. Now, commodities tend to move generally together as well, which is quite useful. Things like gold might go first when it's talking about metals, then silver might follow, because it tends to. I've just put a silver trade on over there. Actually, I'm just watching it. But silver may follow gold, and then other metals might even follow silver. You never know, but things do sort of move together. So that is commodities. I hope you've enjoyed it, and I'll see you in the next training video. Well, hello, and welcome to the training on forex. So what actually is forex? It's foreign exchange in simple terms, so it can also be known as FX. So it's really the currency market. So if you've been exchanging pounds for dollars or euros for dollars or pounds or a different currency, then you are participating in the FX or the forex, foreign exchange market. So just have a think about a time in the past when you've gone to a currency exchange and you have potentially swapped your currency, your native currency, for another currency to a country you are going to. So the forex market is pretty large. Well, it's extremely large, actually. It's actually the largest market in the world. And just have a guess about how much on average it's actually worth. I mean, this number's actually gone up quite a lot. It's over $5 trillion every single day now. So I think when I learned to trade 10 years ago, it was about $3 trillion a day. So obviously it's expanding exponentially. So who actually trades the forex market? There's lots. There's a hell of a lot, really. When you think about it, you're going from the bedroom trader, who's a retail trader, all the way up to the big, the big banks, the big players like the central banks, such as like Citigroup, JP Morgan, and Barclays. I mean, there's many reasons why people trade forex, but what are those main reasons? Okay, so one reason is speculation. So mostly foreign exchange transactions will take place to really make money. And that's the bottom line of it, is to make money, because you're speculating on the price. So you're speculating on, buying a currency against another currency and hoping that will go up in value. Or if you're going the other way, you're shorting it and it's going, you're speculating on the price going down. So this is the biggest market and the most volatile market out there, the foreign exchange market. So big traders and major institutions will be trading out throughout the day. And what this can do is give the speculators out there a chance to make a lot of money, but also we mustn't forget to lose a lot of money. And the thing is with forex, it's going to keep on going in that direction. Possibly it could keep on going forever. One currency could get stronger against another currency. Obviously, it goes in cycles and it goes up and down. But in generally, forex could keep on going down forever for that particular currency. Whereas if you're trading commodities, for example, something like gold, then it could go down in value. Gold could, but it's not necessarily going to be worth nothing ever. And that's one of the reasons why I like trading commodities. But when it comes to forex, there are different tools and different strategies you can use, and you can make sure your risk management profile is controlled, so that you can actually profit out of the forex market as well in a safer manner. So it's really speculation and probability, using the tools that you have to guess which way the markets are potentially going to go next. So buying and selling goods and services in other currencies, this is another reason. So when a transaction takes place, obviously on this short video here, you can see there is a boat, a ship with cargo. So obviously they are using foreign exchange to transfer the finances for goods and services. So the size of these transactions is pretty small in comparison to the foreign exchange market and the speculators, the banks, but there is a considerable amount. So you can imagine a company transferring goods to another country, then they've got to use the foreign exchange market. So how do you actually trade forex? It's OTC. So forex is run globally via a network of banks and has no central location. Okay, so any broker can actually execute trades at any time. And then major forex trading centers. We've got major centers in New York, London, Sydney, and Tokyo. And this is what OTC stands for, which is forex is an over-the-counter market currency, where currencies are exchanged between two parties using an exchange. So what are the hours of trading forex? Okay, so they're obviously different hours at different times throughout the day. So 2100 hours or 2200 hours on Sunday UK time. So 9 o'clock or 10 o'clock on Friday every week is when the market potentially closes. So it doesn't trade throughout the weekends, but potentially opens at 9 or 10 o'clock on a Sunday evening in the UK. So a little question here for you. If you're in the UK, and you can do this if you're in a different country as well, but what time of year will the forex market opening time change if you're in the UK? So just have a think about that. What time of year will the opening time of the forex market change if you're in the UK? If you're in the US or Australia or anywhere else, this is apparent as well, but I'm just using UK for an example. So this is British summertime. Looks very nice there, but this is when the clocks go forward. So it's basically when the clocks go forward in one country, in the UK, for example, they won't necessarily go forward in the US. So you've got to take these things into consideration to ensure that you know when the markets open, when they close, where you are. So how does it really always, well, how does it actually work? So the prices are always quoted in pairs. So as you can see on this short video here, you've got Euro USD at the top, US dollar, Japanese yen, pound yen, just underneath there, and Aussie dollar, dollar CAD down at the bottom. Now, obviously, dollar CAD is Canadian dollar, Australian dollar, pound, US dollar is quite self-explanatory there. So buy one currency, for example, when you're buying the pound, GBP, whilst you're selling another currency. So you're, in this example, you're selling US dollar. So you're buying GBP and you're selling USD. And this is how it works, and this is why you have pairs. So here is a fact for you. So GBP against US dollar is actually referred to as cable because of the deep sea cables which were used to carry buy and sell information between London and New York. Obviously this information is now exchanged through more sophisticated means, but that's where it all started. So this is why it's got a nickname for cable. So here are some examples. You've got the euro and the US dollar, which is Euro USD. The US dollar and Japanese yen, dollar yen. British pound against US dollar, pound dollar, so cable, as we just saw. The dollar and the Swissy franc, so dollar Swissy. Okay, Australian dollar and US dollar, Aussie dollar. US dollar and Canadian dollar, dollar CAD, and then Kiwi dollar, which is New Zealand dollar against the US dollar. So the first currency in the pair is called the base currency, or the primary currency, and the second is known as the counter or the quote. Now, these are the major foreign exchange currency pairs. So there's more liquidity, they move more, they trend more, this sort of thing. But they do move quite differently. So what's quite nice, I quite like trading dollar yen short because it trends down. You can look back at the charts, you can see in the history how these currencies move. So dollar yen, I quite like that one. So pound dollar. So here's some calculations. So £1 is worth £1.20. £1 is worth $1.20. So here, if you're buying the pound and selling the dollar, for every £100 you spend, you are getting $120. Quite self-explanatory. So if the pound gets weaker and the dollar gets stronger, then you get more dollars later on. So you're speculating the price. So you're speculating the price will move in that way, and you'll get more in the future. It could be in a few minutes, or it could be in a few years. You know, that it depends what type of foreign exchange currency you're buying. So if the dollar is cheap against the pound, very cheap, you might be buying it on a long-term basis, or you might be buying it just to get in and get out quickly. So, and the recap for this particular video is all about forex. So all forex really is a conversion of currency from one to another. So the big boys are banks. They're the guys in forex, which in the foreign exchange market, which will be moving the markets by buying a lot or selling or shorting a lot. So most of the trading is done on speculation. So we're really guessing our direction of the trades which we're putting on. We're anticipating, we're hoping, using our technicals, using our fundamentals to look at which direction we believe it might be going. So at the moment, for example, the dollar is weakening because of interest rates have been well, they're talking about reducing interest rates next year in 2024. This is currently we're in December 23. So on that note, you can use that sort of information because there's a possibility the dollar will be weakening now, and we can look at the charts and we can look at what's strengthening. So if there's another country that's potentially strengthening, then you can look at, okay, well, there's more chance now because that one, the dollar's weakening, the other country's currency is strengthening because of the fundamentals, and then you apply the technicals to it as well, then in theory, you can potentially do very well out of it. So forex is traded in pairs. The first currency is known as the base or the primary currency. The second is called the quote or the counter currency. Forex is an over-the-counter market where trade takes place between two parties rather than on an exchange. And that concludes this video. I'll see you in the next one. Well, hi guys, and welcome to the training on who else is actually involved with trading. So firstly, you're going to have market makers. So this is a firm or an individual really that holds the inventory and the continuous quoting prices to the buyers and the sellers. An order through a market maker can be in the form of its own holding, or it can use another party or another party's order to offset your order. This happens straight away, instantaneously, and obviously it's electronically, but most operate within an exchange, and your broker will interact directly with them on your behalf. So you only really need to worry about having a broker account that you're happy with, because they interact with the market maker, and that's how they get the prices and that sort of thing. Okay, so you also have institutional traders. So institutional traders and investors, they're organizations and they work within the financial markets. They're normally much larger than a retail trader or a bedroom trader or even a professional trader. They manage pools of money on behalf of the investors, and they include banks, pension funds, hedge funds, and life assurance, excuse me. And we also have high frequency trading. So this is really the use of bots, trading bots. So high frequency trading is where computers use strategies and algorithms to find trades, patterns, trends, fluctuations in the market. Okay, so they are literally buying, selling, depending on what strategy they're following, and that sort of thing. So these systems can remove the emotional part of trading because a computer's doing it for you. They can trade for you 24/7 if required, and they can open and close trades in a matter of milliseconds, really. depending on the size of the spread, and there's lots of different reasons why, how they can do this. They can literally take a tiny bit of profit for so many trades, and they can catapult the profit to a high level pretty quickly, because it can all add up really quickly. So, bots are really, really good. However, bots do need to be managed, and they need to be strategized as well as manual trading. So it's very, you learn how to be a bot trader, but it's so important that you know the fundamentals of manual trading, and you can actually manual trade as well, because there will be a situation with most bots out there where the price doesn't normally follow the same sort of trend or movements that it has done in the past, where the bots have actually been designed around. So to manage the trades, so sometimes intervening into bot trading is the most successful way to profit out of trading bots. Okay, so to recap, a market maker provides liquidity by holding an inventory of particular security and quoting continuous prices to buyers and sellers. Okay, the institutional traders, like the banks, for example, manage large pools of money, and they trade the financial markets on behalf of institutional investors. High frequency trading uses technology to apply algorithms, placing vast volumes of ultra short-term trades and capitalizing on the brief market fluctuations. So banks might use high frequency trading as well. Hedge funds may use them, but they will still have a team of bot managers to ensure that the bots are performing correctly at all times. Thank you for joining this training, and I will see you in the next video. Well, hi guys, and welcome to the training on who actually trades. So we're going to have a little look at what type of trader you are. Okay, so who is involved in the markets? We're going to have there's lots and lots of different people involved that trade and gain access to the markets. So here we're going to look at some market participants. So firstly, we're going to look at the retail traders, and it's more than likely you are a retail trader. To get a professional trading account, for example, you need to have some significant experience, and you need to prove that to your broker. So more than likely you're a retail trader that's going to be trading the markets, potentially a private individual, buys and sells financial instruments. You have your personal account. You can be trading smaller sizes. So yeah, it could be you. So we have our brokers. So a retail trader can't just walk in off the street and start trading. So you'll need a broker to act for you. And you'll also need an online platform to actually take the trades. So brokers do offer various different services. They've got the full service where they manage your investments. They provide a personal service here as well. And then you've got advisory management, providing recommendations, but the final decision in this setup will be left to you. Then you've got your execution only, so simply carrying out your instructions to trade. So in the old days, you'd be phoning up, instructing your broker to make a phone call, to take a trade, how big the trade was, etc., etc. But these days, everything's online. So you'll be just pressing a button, and that instructs your broker to action the trade. So there's a bit of a difference between trading on an exchange versus an OTC, over-the-counter exchange. So an exchange is a physical location. Brokers and dealers come together to buy and sell. Most is remote, but some traders will be on the trading floor. Now, if you wanted to trade an unlisted stock or forex or something that's not listed on the exchange, you'll need to use your broker dealer. offer as an OTC, over-the-counter market. So an OTC, or an over-the-counter market, exists as a virtual network of participants. You're going to be trading it electronically or by phone. So when I mentioned earlier about the phone, I mean, it still does happen. But in OTC markets, dealers set their own prices. These trades can only be executed privately. Okay, so this is something you probably won't get involved in. Okay, now traditionally trading in exchanges was conducted using the open outcry method in a part of the trading floor known as the pit. So traders would shout, they'd buy now, sell now, you know, and that sort of thing. So whoever had the largest voice always get the trade and that sort of thing. So I can imagine there's a bit of the energy and the stress in that room with these old ways of trading. So a contract was made when one trader called out that they would sell at a particular price and another replied they would buy at that particular price. A bit like an auction, I suppose. You know, you think about an auction even today, when you call out and you agree verbally in front of everyone that you're going to be buying that car or buying that piece of artwork or whatever it is at that auction for that particular price. So if you backed out, then, you know, it's not good. But you wouldn't be able to do that on the trading floor because you'd already be sort of part of the community. So these days, these traditional systems have been replaced with electronic trading systems. It's still used in some exchanges in New York and London, etc. Electronic systems trade faster, but do you get the best prices? That is the question. So really, you've got a couple of different types of traders here. You've got the retail traders, like private individuals who buy and sell using their own personal account. For an FCA regulated, we're talking FCA because it's in the UK and that's where I am. The regulation FCA with the broker potentially will leverage your account from 1 to 30 for a retail trader. If you went to professional account, you need experience. You need to prove that you've you've bought and sold CFDs, which are contract for difference. So it's basically following the price. Anyway, this is really in-depth stuff. But yeah, you're a retail trader, I expect. Going through this course today, you're going to have a broker. It's an authorized intermediary who executes trades on your behalf and may also give you advice. Okay, so they probably will give you advice. They might give you trade alerts. They might tell you what they're going to be trading, or their analytical department has created like a series of potential trades coming up in the future. And they give you ideas. The thing is with the broker will actually profit from you losing in some cases. So if you win, they're relying on most of their traders, if you like, to lose, so they make money. But they also make money on spread, commission, swap, those sort of things. So a broker, it's very important you choose the right broker. I have a recommendation within this training area, which I'll get to in a different video. But so you've got an exchange as well, which is a central physical location where brokers and dealers come together to buy and sell. And then you've got OTC markets, which are traded via a virtual network of broker dealers. So OTC markets is potentially what you're going to be using as well. So this concludes this training today, and enjoy and have a good day. Well, hi guys, so in this training we're going to be looking at different types of charts. So when you're trading or when you're analysing and you're looking at the markets, you need to decide on your favourite style of charts. They all say the same thing, they all demonstrate the same bit of information, but some people find some charts easier to read than other styles of charts. So when you've got types of charts, you can see here this is a chart basically in the background. So the three main types of charts, you've got a line chart, you've got a bar chart, and you've got a candlestick chart. Now the first one here is the line chart. So this is really good for displays, the open and close price. It's good for identifying patterns, like an overall. So you zoom out and look at a pattern, and sort of understand it from that way. But one of the disadvantages is you can miss the price action movements. So it's not used that much for normal trading with many traders, because it's just an overall view, I guess, of a pattern or a direction of the overall price. So then we have the bar chart, which is HLOC. So HLOC stands for, as you can see here, high, low, open and close. So open price here, and then in that particular time frame the price might have gone up to the high here, come down, gone to the low here, and it might have gone back up again and closed here. Okay, so it displays the open price and the close price, so it's quite clear, so you can see when it opens and closes, and it shows the highs and the lows for each period, and it's good for clearly seeing when a bar opens and closes. So here is an example of an HLOC bar chart. So as you can see here, there's green bars at the beginning, so you can see where the price opened, where it closed, where this one opened, closed, this red one, and it's the same with the red or the green bars. It doesn't really matter what color it is. Generally, we look at when the price is going down, when the bar closes at a lower price than it opened, it's red. It can be a different color, it can be yellow, it can be whatever you want it to be. But it's quite nice to sort of see the green as well. Green is normally a buyer's bar, and a red is a seller's bar. Okay, so then we have the candlestick charts. Okay, now the candlesticks are my favorite. They are the same as the HLOCs, but it's shown differently. Okay, so the color can represent the price going up and down. So in this case, obviously it's green for the open here, and you can see the same information. But when you're looking at a chart, an overview of a chart, it gives a clarity on the direction, cycles and that sort of thing, price action, which is very, very important for trading technically. So this is a bullish candlestick. So bulls, you've got the bulls and you've got the bears. The bulls are the buyers. So green is represented normally as a buyer, and then red is normally represented as a seller or a short seller. Okay, which we'll get into later on. So the body of the candle opens and closes within the range. The wick is the high or the low range. So the wick is here, so it's gone up to that high there, and it's gone down to that low there. On this one, same with that one, high there, low there. It's red or black normally shows red or black normally shows a price decrease. Okay, from the open to the close, or green or white shows the price increase. Normally green, normally red. But yeah, if you've got lots of different charts, it's quite nice to vary the colors, because then you can identify which particular chart you are looking at. So, candlestick chart is the most popular. It's my favorite. A large amount of data can be analyzed quickly. It's easy to read, certain patterns, easy to spot. It gives you clues on the balances between the bears and the bulls. Okay, so this particular image, it shows there's no real direction, there's no real clarity on the direction. But you see at the beginning, you can see quite clearly that the price is going up here, because it's a buyer bar, It's another buyer bar. This is called a low test bar, by the way, but it's not on the apex, so you wouldn't really use it for technical analysis. So okay, you've got a red bar here, but it's only a small red bar, and the price has gone up to here. Then obviously the price has come down, and then it's sort of faffed around here, and you can see this one here. This good example, really. You see the price has shot up in that time frame. Now each one of these bars can represent a time frame, so it could be the 1 minute, it could be the 5 minute, it could be the 15 minute, it could be hours, it could be weeks, or whatever. And you'll see that later on about how you identify the time frames. Now, long body candles. Okay, so long is buying and short is selling, short selling. So long green bar shows a lot of buyers, long red bar shows a lot of sellers. When we say sellers, we're meaning short sellers. Okay, so in other words, they are shorting from here, the short sellers, this price, ideally, and then they're buying down here. So they're shorting and they're buying. Okay, and that means that they can profit from the price going down. So when you think about a commodity or the value of a piece of gold, for example, gold's a good one. I use that a lot in my analysis because everyone can think about a piece of gold. It's tangible, it's a metal, it's a precious metal. We all generally know what gold is, so this is why I always talk about gold. But if you bought some real gold, okay, at this price here, the price of gold went up to here, and you sold it, you'd make profit. Now, if you bought some real gold and you bought here, and then you sold here, you're going to lose profit. You're going to make a loss. But if you're on the markets, you can actually short that gold price by using the exchanges, etc., to actually short it and short sell here, and then the price, you're out down here, and you've made a profit on the way down. Okay, so you've got long shadows. So these are long wicks and short bodies. They can show pressure really in one direction. Okay, so the long upper shadow, or a high test bar, it can be named as well. It can show that the price has opened here. Okay, it's closed lower, that's why it's red. Okay, and it's gone up, right up to there, and it's turned around and come back down again. So the bigger the time frame, the more verified that particular bar would be. So if it's on the 1 minute and it's gone up and gone back down again, closed in 1 minute, then yeah, it's not that valid. If it's on 5 minutes, a bit better. An hour, better again. 4 hours, that's quite strong, you know. But you imagine if you zoom in to the charts, this top, that could be, there could be a high test bar in there on the 1 minute chart. You see, so if you're waiting for the 4 hour to go up and down again, yeah, if you're trading slightly longer term, if it's a daily, for example, imagine that as a daily, it got up there in a day and it come all the way back down again, then you've missed all of this short selling you could have made profits on. So, you know, we normally do our analysis on the higher time frames, and then we zoom in to the lower time frames to see when we can get in. Okay, so this is a high test bar. Could be known as a hammer as well. Various different names for it. I like high test. You've got long shadows. So you've got long shadow here. So this is more of a low test bar. So the price comes down and it's gone back up again. As for that, so this is really chart analysis, looking at the price action. So what has the price done in that period of time? What has the price done in this period of time? Okay, so to recap, we've got 3 types of charts. You've got the line chart, you've got your bar chart, and you've got your candlestick chart. Okay, line charts only use the price at close, so you can't see the price action. But it's good for pattern spotting. It's good to show the direction of what something might be going in. Okay. Bar charts show the high, the low, the the open and close price for a period, which can be a favorite for some. But personally, candlesticks, which is the most popular, they are the charts. They show the body. The body shows the range between the open and the close. The wick shows the high, the low point, and the color shows the direction of that bar. So when you're looking at a chart, it's clearer, in my view, to see, to be able to understand where the price is going or where it might be going, with a candlestick chart. So I never use candlestick charts. For our bot trading, we might just use bar charts because that's just, we're not really chart reading, but it does actually make more sense to use candlesticks for trading in general. And that concludes my video on the three types of charts. Well, hi guys, so in this video we're going to talk about going long and going short. So you've got the long way up, you've got the short way down. You're walking up the steps and you're coming down the elevator. Okay, it's just a couple of examples to remember about going long and going short. Okay, so on that chart you can see going long is up and going short is down. Okay, so long and short. So most people think of trading in one direction. So if you imagine buying real gold, buying it at a low price and then selling it when the price gets higher, which is great, but you're only trading it one way. So opportunities can arise when gold is looking to drop in price. And this is called short selling or going short, the short way down. Now the difference between going long and going short. So going long, you buy the asset whose value is expected to rise. Then you sell when the price is higher. You go short, you do the opposite. So really, you're short selling high and you're guessing or anticipating or betting on the price coming down, and then you close out at a lower price and you actually make profit on the way down. Okay, so there's two types of selling. You know, if you're buying and then you sell, you're buying and you're selling. Whereas if you're selling short, you're shorting the price down. And thing is, sometimes various different instruments actually do come down pretty quickly. You know, they take a long time to go up, but they come down really quickly. Like oil is a very good example to that, actually. You know, oil it takes quite a bit of time to go up most of the time. You know, it builds in price with supplier restrictions and that sort of thing. It comes back to the supply and demand. But you know, when you short oil, it can literally drop like a stone. So buying oil is a tricky one. So right, to recap here, we've got trading by buying an asset is called going long, while selling is going short. Obviously, like I mentioned a minute ago, you can buy and then you can sell. That's just one. You're buying one transaction, you're selling another transaction, potentially make profit, or you might buy and then the price goes down and then you sell lower and you make a loss. Okay, but if you're shorting from up high and the price comes down, you can make profit. But if you're shorting and the price is high and it goes higher, then you could make a loss. Okay, so to open a short trade, you sell an asset whose value you expect to decline. To close, you buy it back, also known as covering. So if you can buy that asset back at a lower price, you pocket the difference. Okay, so if an asset's value increases, the short sellers will lose money, while traders with long positions profit. In order to sell an asset you don't own, you must first be able to borrow it from a lender. Okay, so that would be an exchange or whatever. So you can be called away from a short trade if the lender needs to reclaim the asset you've borrowed. If you borrow shares to sell short, you will need to compensate the lender for any dividends or other corporate actions announced during the borrowing period. Now, don't worry about those bits. Obviously, like on a platform, if you're short selling, then you can, the actual platform you're using and your broker, combined with your broker, actually sorts all that out. So you just got to make sure you decide on the right direction, and that is the hard bit. But you use your tools, and you use your mechanisms, and you use your experience, and you're learning the fundamentals. You're using your technical analysis to decide on whether you're going long or whether you're going short. And in simple terms, if the price of something's low, I mean really low, then you buy, you go long. And if it's really high, more likely it's going to come back down again. So that's when you short sell. Not as easy as that, but generally that is what you want to be doing. So this concludes my video on going long and going short. Well, hi guys, and welcome to the training on trading forex. But before we move into the training, just want to mention this book. This was one of the first trading books that I read many years ago, Trading in the Zone by Mark Douglas. Very good book that. I'm going to have another read of it very soon. Okay, moving on to the training for today in this particular lesson, trading forex. Okay, so here you can see there's a forex pair on the screen. It's pound GBP against US dollar. So remember, if you're buying this, you're buying GBP and you're selling USD. Okay, so the way that forex is calculated, it's very different to stocks and shares. So in shares, they're measured in a slightly different way. They're measured in cents or pence or pounds or dollars or whatever currency, whereas forex is measured in pips or price points. It's a very, very small unit. A pip is usually the last decimal place of a price quote. So most pairs go out in 4 decimal places. Okay, so Euro USD at the bottom, for example, is 4 decimal places, 0.0001. But the Japanese yen pairs, they're different. Okay, so it's just something to bear in mind. They're 0.01 for a yen pair. Okay, so let's have a quick look at this calculation. If dollar CAD moves from 1.19527 to 1.19617, how many pips has the price moved? So the example is Euro USD is 0.0001 and dollar yen is 0.01. So it's going to be the first one, 0.0001. Okay, so let's just have a quick think about this. We need to get our calculators out. If you haven't already got one, you might have one on the phone. I would recommend don't use your head for this. I mean, it's at the end of the day, it makes sense. This is when you can use a calculator. We're not in a maths lesson here. Make use of the tools you've got. It's very important to get these sort of things right. Okay, so now you've got your calculator. The calculation would be, so we want to take one away from the other one. So let's say the highest number is a 1.16. Sorry, it's not actually. It's the other one. 1.19617. Okay, and you're going to minus 1.19527. Okay, so that's given us, don't know if you can see that, it's 0.0009. So that's 9 pips it's moved from. Okay, and the way to verify that is obviously adding 9 pips to the first number. So 1.19527 plus 0.0009 Okay, so you're adding 9 pips on top, and that should give us that other number, 1.19617. There you go, it's there. So that's 9 pips difference. Okay, because we're talking about absolutely tiny little measurements here on each potential trade. So what they do is they measure in lots, and we buy in lots. Now, lot is a group of contracts or a group of units. Generally, a standard lot is 100,000 units of currency. Okay, so there's also micro lots and mini lots, but standard lots are 100,000. So what we're going to be doing in the future, I mean, there's a thing called leverage, as you can see here on the left hand side of the screen. Now, leverage is when the broker lends you money to be able to trade with more, basically. So, for example, an FCA regulated broker, someone that I recommend we use in the UK, because it's FCA regulation, you're insured up to sort of around £80,000 if they disappeared, and the regulation means that it's a lot safer than a non-regulated broker, for example. So leverage means that a trader can open a large position with a smaller amount of money. The profit will be based on the full amount, but so will the losses. This is called margin, but can be very, very risky. Okay, so if you're leveraged to 1 to 30, as an FCA broker would allow for a retail trader, that's every £1,000 you've got in your account, you can trade with 30,000. Okay, so your deposit is 1,000, you can trade with 30,000. So it would allow you to buy a fair chunk of a lot with that £1,000, and that is what leverage is all about, to allow you to do that. Now, it's great when you win, but it's also bad when you lose, because that sort of leverage is not massive, 1 to 30, and that's why the FCA regulated it to 1 to 30 for retail traders, whereas my professional trading account, for example, is leveraged 1 to 500, and that's on a big account as well. So I'm not going to say the figures, but it's leveraged to a lot. So this is why it's extremely risky, because I can buy potentially massive amounts of forex or commodities or whatever I'm buying. And this is why I really buy on that account. I've probably mentioned another video on that account, the big professional trading account that I trade with. I buy mainly commodities because commodities are quite predictable. They're quite expensive to trade in terms of the cost of the trades if you hold them for a period of time. However, gold, in my view, is never going to go to zero. It's never going to be worth nothing because it's gold, and this is why I trade things like commodities. So, right, so a trader can trade on leverage with most brokers. The amount of leverage depends on the experience of the trader and the size of their account. Okay, so when we're talking about leverage, let's just jump back in there. The size of your account, so £1,000, if it's leveraged to 100, for example, then you can trade with £100,000, but with £1,000 in your account. But you imagine if you did do that, and you imagine if your trade that you bought, let's just say you've got £1,000 in your account, leveraged to 100,000. You've only got £1,000 of movement before you lose that £1,000. You see, so it'd be less than 1,000 actually. That the broker would cut it off earlier. So, so then you would lose that £1,000 pretty quickly. So really, it's best to start small, little, and often, and learning it that way. So we got standard lots, 100,000, mini lots, 10,000, and micro lots, 1,000. So the major pairs for forex, you can trade almost any pair combination in the world, if you can find a broker that wants to trade it, that is. But generally, the major currencies are the ones that are traded. So these these currencies here, so pound, dollar, euro yen, euro dollar Swissy, dollar CAD, Aussie dollar, they are the major pairs. Now, there's more liquidity in the markets. They're going to be traded by more people, more traders, more investors, more hedge funds, more banks, etc., etc. So potentially there's more volatility, and when there's more volatility, there's more liquidity, and there's more trading opportunities. You see, so if no one's buying, no one's selling, the price is just staying there. And last thing you want to do is get into a trade and you're just sitting in a minus a little bit and it doesn't go anywhere. So this is why we need liquidity and volatile markets. Not too volatile, but pretty volatile. So these are the big major pairs there. Then you've got the minor and exotic pairs. So other pairs that are traded that are less known. So they're called the minor currency pairs, or cross currency, or crosses. It's mainly the dollar, when the dollar's not actually involved. So the most popular miners tend to contain pound, euro, or Japanese yen. So there's exotic pairs. They can include such currencies of the Mexican peso or the Polish zloty. Okay, so lots of exotic pairs as well. So here's some for an example. Aussie NOK, Australian dollar, Norwegian kroner. Okay, so you've got quite a few here to have a quick look at. So, why do currencies strengthen and weaken? Causing the price of a currency to change. Basically, it's all about the economy. So, if the economy gets stronger, then the currency gets stronger. If the economy gets weaker, the currency gets weaker. There's things like interest rates as well affect this, inflation. There's lots of different reasons why, but it's all based on the fundamental, really. It's all about the economy, and that's what strengthens and weakens the currency. So you can use this information, you can use the news when we get data to sort of forecast and maybe jump on a trade, or however you do it, but there are ways of using the economy to decide on whether the currency is going to get stronger or whether it's going to get weaker on the short-term basis, mid-term basis, or long-term basis. So what factors can influence a currency's price against another? So we've got imports and exports, government policies, interest rates, inflation rates, as I just mentioned, economic figures such as unemployment and manufacturing data. So these sort of news items, you can actually get these news items on, my favorite actually is Forex Factory. So go to www.forexfactory.com and you'll find a calendar and you can tune that calendar. It's the same with MyFX Book and all these other calendars. There's plenty out there, but it's very good depending on what you're trading to sort of know what news is coming. Because when you look at the movement of the dollar, for example, it does tend to move in certain ways, and those ways are normally depicted really by the market news. So like inflation rates, if inflation is coming down, then the dollar may also come down a bit. Because if interest rates are going, if they're going to increase interest rates on the dollar, then people will buy the dollar because pushing the price up because they're going to get more interest by owning the dollar. You see, so and it's like gold goes the opposite direction to the dollar, for example. So most of the time, this is 99 times out of 100, it does. Not every time, but if dollar gets stronger, gold normally gets weaker when it's trading against the dollar. So everything's in pairs. Even gold is in pairs. Even silver's in pairs. Because it's trading against a particular currency. And it's always good, really, I think, to we trade the dollar mainly because it's the most volatile. It's the Federal Reserve currency. It's the main currency in the world at the moment. But it's starting to devalue now because they're talking about interest rates coming down next year in the States. So when they do reduce interest rates, less people buy the dollar. Dollar's now dropping. Gold is going up. You see, so you can sort of look at all these influences to the currencies, to the markets, and use that information to decide on which way you want to go, either buy or sell. Okay, so to recap here, forex movements are measured in pips. Forex is traded in lots. Currency pairs are mostly classed as major, minor, and exotic. Most of the time, the stronger the economy, the stronger its currency. And that concludes my video for today. So in this video, we're going to be talking about investments. What actually are they? How do they work? And what they're all about. There's lots of different investments out there to get involved in. And we're just going to cover a bit of an overview of what are they. So really, an investment is the allocation of money or funds or resources in the expectation of receiving a profit or a future income. So let's say, for example, you invest in a buy-to-let property. You're expecting the property to go up in value. That's one part of it. But also, you're expecting to get an income from the rent. So in financial terms, it involves committing capital to an asset or a project with the goal of obtaining returns over a period of time. So investments can come in many forms, but the choice of investment depends on these following factors. So it's the individuals or the institution's financial goals. So what are you planning to get in terms of return? So if we go back to the example of investing in a buy-to-let property, like a flat or something, your goal really is to maybe sell that property at some point at a higher price and make some profit there. But in the meantime, your goal and you're expecting to receive an income every month from renting it. You might not be able to rent it every month, so there might be times when there might be gaps. So there's no rent. So if you're buying that property with a mortgage, then you've got to take these sort of things into consideration. If you're buying it cash, then, would your cash be better somewhere else? So there's lots of things to take into consideration. You've got your risk tolerance and appetite as well. So just talking about property here. Now, property is very low risk because you probably heard the saying, safe as houses. So, generally you're buying a property with a larger sum of money over a longer period of time, expecting an appreciation in the value of that particular property. Now, you can actually go and invest in something really short term as well. It doesn't have to be over a number of years. Like a property, it can be something like a cryptocurrency, for example, that you've read about and you learnt about and it's coming up and it launches, and it might be extremely high risk, but it can be done you can make a lot of money in a few minutes, even in some cases. However, you've got to write that money off in the first place, because if you put £100 into that investment, you're probably more likely to lose that £100 because that particular cryptocurrency you invest in might not work, might not happen. Whereas, would it be better to put that £100 you're going to risk on that high risk? If you only got £100 available to invest in investment, then would it be better to put it in a bit of a more stable investment? Like a piece of gold when it's cheap, for example. That sort of thing. So there's lots of reasons why. So we've got risk tolerance, we've got time, and the financial goals. So the key elements an investment includes are, so your capital commitment, how much money are you prepared to put into that particular investment? Obviously, higher risk wants to be less money, and lower risk, possibly more money. invested in. Now, we've also got other ways of investing in various investments by using your experience, your knowledge, and time and effort. So, for example, let's just say you've got a hotel, and that hotel owner needs a manager, but needs a very good manager. They may decide to give the manager 1% of the company, a very tiny percentage of the company or the hotel, so that the manager is then incentivized to basically make it extremely busy and very successful. And that way, the owner can get a very successful business, and he's only given away a tiny bit of his business, but the business is 10 times better because of that particular manager, for example. Now, the manager wouldn't be putting any financial commitment in. They are putting their experience, their knowledge into that particular system, or that particular investment. So he's investing his time, his effort, his knowledge. So one thing to take into consideration seriously is return on investment. So if you're investing in a property, for example, and you're expecting it to increase in value by 1% a year, that's fine. But if you're expecting it to increase 100% in a year, it's not going to happen. It's very unlikely it's going to happen unless you build it, I guess. So, you've got to look at return on investment. What are you expecting your capital to turn into? If you're putting in this much, are you expecting this much over a period of a year? Are you expecting this much over a period of a month? What are you expecting from that particular capital investment? So are you going to be paid interest? So if you're investing in just a normal bank account, for example, when interest rates are high like they are at the moment, you're going to be paid interest on your capital. But would it be better to put that capital not with a bank, because a bank potentially is not going to return you that much over a year? Would you put it with a company or a stock or whatever? Because in some cases you might be paid dividends. Now the FTSE 100, for example, which is the top 100 companies in the UK on the stock market, those top 100 companies, if you buy the FTSE, you don't have to buy with, you can buy with £100 or whatever you want to put in. That £100 you invest in the FTSE, you could be looking at two revenue streams from there. You could basically be looking at buying the FTSE low and selling it high, and that's trading it. Or you could just be buying the FTSE to receive the dividends, and then you're just investing long term in the FTSE, and then you might sell it later on, but it might have devalued, so it might not be the right investment for you at the time because of the price is too high when you buy it, for example. So it's all about return on investment, what you're expecting to get in return from your investment. Now, risk is the biggest key factor in all of this, really, because if you've only got £100 to your name, then you don't want to be putting your £100 into cryptocurrency because it's more likely you're going to lose that £100. Now, there's lots of different risk levels for so many different investments. So it can fluctuate, it can go up and down, market conditions, economic factors, many other variables. I put this little picture in here of a guy tightrope walking across, a big tavern between two huge mountains or whatever. So that is extremely high risk. That's like a cryptocurrency punt, but then if that was hundreds or thousands of feet off the ground, then it's extremely high risk. Whereas if that was only 2 foot off the ground, it's not that risky, because if he falls off, he's just going to fall down 2 feet. So, you can look at these sort of risk parameters, but risk is a massive, massive thing. And it's based on you as an individual, really, and what your risk appetite actually is. Okay, so timing is obviously a massive factor as well. So are you planning to be in this particular investment for a short period of time, or are you planning to be in it for a very long period of time, or do you not know? So it's quite important to, when you're deciding on that particular investment, do you have an exit plan? Maybe you don't have an exit plan. I remember when we bought the hotel, we didn't actually have an exit plan, because we had planned to have the hotel for forever, really, and expand in that way. However, things changed, and because of various different factors, we decided it was time to build our exit plan and sell the hotel. Now, we obviously sold it at a higher amount than we actually bought it for. However, but we also had an income coming from it throughout the period because of what we'd done to it and everything. So, over time, that was 13 or 14 years of my life. So it's a long investment, really, long-term investment. Whereas you could go in and be in a cryptocurrency, for example, in a few minutes. You could buy the FTSE, like I mentioned, or a stock of another kind, and be in for a few minutes or a few hours or a few days. It all depends really on what you want to do, what you want to achieve, and how, what your plan is. So it's all about planning. Obviously, if you're planning to buy your first home, or you're planning to buy a second home, or whatever you're planning to do in terms of a property, then you're anticipating you're going to be in it for a longer period of time. And you're not necessarily buying it to make money on. You will, because naturally the prices of property do increase over a period of time. They go up and down like anything does, cycles. But what are your financial goals? What you're expecting in that period of time is key, really. So diversification. Now this is also very important, because you've got to spread your investments across the board. There's no point in having, if you could afford to buy 10 houses as your investment portfolio, then great. That's great. And make sure that the right things are invested in. But if you bought those 10 properties, for example, one of them might not rent out all the time. And that one that doesn't rent out might be the one that eats up the profit on another one, for example. It's the same with businesses, when you've got like multiple businesses. But generally, rule of thumb, I say rule of thumb, what I like to do is I like to have approximately 10 investments running at any one time. So my low risk investment is at one end, and that's some flats that we own, and those flats, they rent it out. They pay us a small income every month. It's a very, very small income. It doesn't really do very well, but we are anticipating that those flats will go up in value, and they more or less pay for themselves and make a little bit of profit now and then, but they're not. They weren't planned to be bought and sold quickly. So we decided we were going to keep, buy them and hold them for like 13, 14 years or whatever we've had them for, and they've just been paying a bit of an income in the background. So, but we will sell them at a higher price than we bought them for. So that's a long-term investment. And then down the other end of the scale, I've got the high risk. I'm going to call them rubbish coins, but there's another word for those coins, which are high risk cryptocurrencies. So then I might throw in £100 or something to 10 of those particular coins over the course of a month, and then one of them, 9 of them might lose, but then one of them might actually do the thousands or the tens of thousands percent in some ridiculous cases. So, that's high risk. So my rule of thumb, really, if I'm investing in one of those cryptocurrencies, which is high risk, I'm likely to lose that money. But if I hit on one that does well, then it can pay off all the losses, and it can literally do very well. So you can make money doing it that way. So you're diversifying between all of your portfolio. So you might have property at one end, cryptocurrency at the other end. You might have gold in the middle. You might have a business in there as well, a portion of a business. You might have some stocks that you've invested in. You might invest in classic cars. All these sort of things you might invest in. But generally, rule of thumb is the lower the risk, the bigger investment. The higher the risk, the smaller investment. So here we're going to look at the common types of investments. So stocks, and now I've put a picture of a Tesla on there because I do trade Tesla as a stock, and general rule of thumb with these stocks is to buy low and then sell high. I've seen it before when some of my clients have got passionate about a particular stock and they go all in on one stock because they love the project, they love the business, and then it's just gone down in value, and they've eventually just held it and held it and held it, and then eventually sold out and taken a loss. And so it's quite a tricky one to pick the right stocks, because you think about Amazon, for example. When Amazon launched, you can imagine there were lots of other stocks to choose from at the time. Now, if you're lucky and you got in at Amazon and it increased that much in value at the right time, you could make a lot of money. But you've got to get out as well. Don't forget, you've got to sell those stocks and transfer them or swap them back for pound coins or dollars or whatever currency you're talking about. So, the easiest, the best way, really, in my view, is to buy low. But it has to be a good project. And at the moment, for example, Tesla is about $250 a stock, a share. So, it's quite high already. So it's in the middle. Is it going to go higher? Is it going to go? Who knows? But what happens with stocks is they can get moved around by good news or bad news about that particular company. So, for example, when Elon Musk bought Twitter, the stock price plummeted. It all went wrong. So, you've got to be so aware of it. You wouldn't expect someone like Elon Musk to buy something and then it goes wrong, So it does happen to everyone, really. Now choosing a stock is quite a tricky one. It's always good to look at recommendations, always good to look at the news and understand more about that stock before you actually buy it. But even if it's a really good stock and you buy at the top, that could devalue. You can hold it, but one thing you've got to be careful of, if you're buying that stock and you're holding it for a long period of time, depends where you're buying it. If you're buying it through an exchange or broker, then you could be lumped with a lot of fees. So if you're in a negative and then you've been lumped with a lot of fees on top of the negative, then it's like double whammy of costs, because you could potentially lose and you get charged as well for losing. So you've got to be careful with these sort of things. I mean, I've bought Virgin Galactic, for example, quite low. I didn't think it was going to. I mean, you look at the chart, and I mean, it's been up so high and then it's come so far down. I bought it there, and it's gone down further, and it's just stayed down there. It's even down to about $1.50, I think now. And I bought about $6, but it's been massively higher. So you don't actually know, and you want to get it obviously before it. Because sometimes it gaps up, the market closes, the price changes, out of hours trading happens, and it gets traded up higher, and then you know, and then if you're in there, then it's fine. It goes up there. But if you're not, it's a tricky one. But yeah, stocks are, if you get them right, they can be quite good. Now, bonds, government bonds are very, well, they're secure. And, you know, bonds do increase in value at times, but it's the same with everything, really. Everything goes in cycles. So, bonds can be pretty good from a safety point of view. Whereas, you know, in terms of the actual return on investment, um, who knows? It's another question, isn't it? Buying it low and selling it high, if you can do that. So, a bond is a debt security where the investor lends money to an entity such as a government or corporation in exchange for periodic interest payments and a return of principal. Okay, so you've got real estate, so physical properties, residential, commercial, or industrial real estate. Okay, so exchange traded funds, so ETFs, mutual funds. So pooled investment funds that gather money from many investors to invest in diversified portfolio of stocks, bonds, or other securities. So saving accounts, so you've got certificates of deposit. So these are really low risk investments offered by banks that provide interest on deposited funds, ISAs, that sort of thing. Now, these are the risky ones, the entrepreneurial ventures. So, investments in businesses, startups, projects, expectations of future profits. You know, and you can do this pretty easily with various different cryptocurrencies and launches, or even a public sale for a particular company. So yeah, I mean these can be pretty lucrative if you get them right. But on the other hand, if you're investing in a project, I remember once, I'm not going to say what it is, but we nearly invested with a guy that had these devices he developed, and it looked really good. They had lots of funding from various different companies and all this sort of stuff. And I think they crowdfunded a good few £1 million. And it was me and my father, and we were going to invest with them, and we decided it wasn't quite right, and lucky we didn't. But the minimum investment, I think it was £50,000 for the minimum investment that they were expecting. So you couldn't go in with less than that. You had to put in a minimum of 50. Now, if that if if we'd done it, we would have just lost that 50,000 because it all went wrong shortly afterwards. Because he didn't commit and didn't actually make it work. We were relying on this guy to make his project work if we'd done it. So luckily we didn't do it. So, but in some cases, you know, I doubt you would have been able to invest in Amazon as an actual company. But if you'd invest in the stocks and you get the right stock of Amazon at the time, at the beginning, you know, then that is also investing in a potential big uplift in value. So, you know, there's lots of different things to think about with these sort of projects, and the main thing is not letting your emotions get in the way. You know, look at the card, cold facts. You know, what is it? How much is it going to cost? How likely is it to work? What security have you got? How are you really guaranteed with your money's going to actually get a return? All those sort of things. So these can be quite risky. So really what we're saying here is investing, it involves a trade-off between risk and potential reward. So individuals often tailor their investment strategies to align with their financial goals and risk tolerance. So going back to the previous slides about your financial goals, what are you anticipating? What are you expecting from that particular investment? And what is your risk? How much you're going to put into that particular investment? So it's vital that you do your due diligence and you conduct thorough research. You look at that investment. For example, there's a piece of land in another country. I'm not going to mention it too much here, but we looked at it and it was looking pretty good, but it was slightly in the wrong location. So because of that, we didn't move forward. It's investments really that you got to really do your research and really look into things, even if it's a small um, cryptocurrency that's about to launch and you're going to put in a very small amount of money. Even do your research on that, because you may have 5 or 10 of those cryptocurrencies to look at, for example, and your research may decide which one looks like it's going to potentially 10x, 100x, or whatever. And when I say 10x, 10 times the value, so that's vital that you do your homework basically on that particular investment before you actually put any real hard cash into it. Even if you're putting your time into an investment and it's an investment proposal, you're not risking you're risking a time, but you need to do your work before and still understand what will be required of you to make it work. Okay, so that includes this video about investments. So here we're going to be looking at the purpose and the reasons why people invest. So there's 3 main reasons here. So we've got wealth accumulation, we've got retirement planning, and we've got education funds. Okay, so generally most investments, if not all investments, will fit into one of those categories. I know some people may invest to have fun, but it's because they got the money and the wealth accumulation already, just to have fun with investments. So they tend to be the smaller investments, but generally it's those 3 items. So when it comes to wealth accumulation, the objective here is, well, the primary goal is to build and increase one's financial wealth over a period of time. A strategy, investors may focus on the long-term growth in investments such as property, stocks, real estate, to harness the power of compounding and capital appreciation. So if the capital appreciation, that property is going up in value, and maybe they're having rent paid to them as well while they're owning it. So they're even getting the bills paid for or whatever. So compounding is very, very interesting, because compounding interest is very clever. So I think it's invented by or founded or discovered by Einstein. And compounding generally is, if you imagine your investment is increasing 1% a month, so you're making 1% profit on your investment a month. Every 1%, the second month has also got the previous 1%. So it's 1% of the bigger amount. And then the next month, it's got the 1% of the previous month and the 1% of the previous month again. So it's getting even bigger. So you can imagine the compounding is very, very interesting to see this sort of calculation. You can do the calculations on a spreadsheet, and you can work out how to, what sort of investment, because, compounding interest is a way of increasing an investment's value pretty quickly, actually. So here we've got retirement planning. So the objective here is saving and investing to secure a financially comfortable retirement. So pensions, that sort of thing. Strategy, emphasis on a mixed growth and income producing investments. So again, it could be income producing investments, could be property that you rent out, so it's giving you an income and it's going up in value. Diversification and risk management become crucial to preserve capital as retirement approaches. So, gold will not pay you a dividend, and it won't pay you interest, but it might go up in value quite a lot. So, and generally over time, you're still going to own gold, and this is what's quite nice about these sort of investments. Bitcoin, Ethereum, and is it Ripple on that image there? So those, any cryptocurrency really is high risk, but if you buy a cryptocurrency, like I did many years ago, I bought probably about 10 years ago. I bought a load of Ethereum, and I think it was around about 60, 70 pounds per token. Bearing in mind it went up to £2,500 per token in the last bull run, which is a bull run is when the price is going up of something. A bear run is when a bear market when the price is coming down. So in the last bull run, I did sell it all. I didn't sell it right at the top, but I sold it on the way up and I sold it on the way down. So I got out, and I got some really, really good. So that was a good investment for me there. Now, you've got to diversify your risk management, and look at different investment opportunities that suit you as an investor. So, and then we have educational funds. So, planning for the educational expenses of oneself or a family member. So, strategy here, investors may opt for a combination of growth and relatively stable investments, considering the time horizon until the funds are needed for the education. So, I like to use a property example because we can all relate to that. So, you could buy a property, and then when your children, for example, are ready to go to university, you could sell that property and use the funds and the profits from that to pay for your child's education. So the purpose of education, the purpose of investing is the wealth accumulation, the retirement planning, and educational funds. And that concludes this video, and I'll see you in the next one.